Good morning and happy Tuesday. Michael Shotnick, branch manager of Sierra Pacific Mortgage here. Wanted to create a video chatting about mortgage insurance this morning. Being that every other radio ad is a mortgage advertisement these days, it's a bit unfortunate that there's still rumors and bad info out there, specifically regarding mortgage insurance. And the guidelines do change. The target's always kind of moving there, so it is hard to keep consumers up to speed. But that's where we come in, and that's the purpose of this video. So there are really just a handful of competing loan types available, which apply to different situations, and that's where we come in, is suggesting what we think is the best fit. So the most broadly used loan is a conventional loan these days, and with conventional financing, one of the rumors is you need 20% down, period, and that's not true. As a first-time home buyer, you can put as little as 3% down. Non-first-time home buyer, so if you've owned in the last 3 years, you can put as little as 5% down. With less than 20% down, mortgage insurance is required. However, you have options on how you'd like to pay it. You can pay it in your monthly payment, and it'll fall off over time, or we can build it into the interest rate for you. If your agent's giving you credits, the seller's giving you credits, or if you have some excess cash you'd like to apply to the transaction, what we call lender paid PMI is a really good solution to put minimal down and avoid mortgage insurance. And with first-time home buyer products, there are incentives for first-time home buyers built into our pricing. So what we can do is use these incentives to cover the mortgage insurance. You can put as little as 3% down with real nice pricing and a great payment, because you don't have that extra aspect of your payment on a monthly basis. So long story short, conventional financing, 20% down is required to avoid mortgage insurance. However, there's some creativity. And if I or we are aware of the whole scenario, we can shape the financing in a way to meet your expectations, get you qualified for the property, and do it in a way that we're maximizing the benefit of the loan for you. FHA, on the other hand, is really the broadly available competing product. FHA does have mortgage insurance regardless of how much you put down, and it's permanent. So FHA is used sparsely these days, and really targeted towards, I would say, lower credit score borrowers, because the rates are good. Even though there is mortgage insurance, the monthly payment is competitive with a conventional loan. However, long term, there is not as much savings because the mortgage insurance doesn't go away. So FHA can be a product to get someone in a home with comfortable pricing, but generally the strategy is to make it a 3 to 5 year loan opposed to long term, whereas a conventional loan can be a good fit up front and then also long term. So to kind of recap here, conventional, a lot more options, generally more favorable, especially low down payment, and from a pricing perspective with a higher credit score, whereas FHA on the other side has good pricing. Mortgage insurance is permanent, so there's kind of a give and take there. Michael Shotnick, again, branch manager of Sierra Pacific Mortgage. Would love to chat with you about your situation and determine which loan product may be of most benefit for you. Thanks so much, and have a great week.